So recently I booked a loss of around 1.5 to 2%, I guess, on a company called Arvind Smartspaces. The stock broke out of the yellow line. However, during trade execution, I got shaken out. So I was not able to handle that trade. So I will show you my struggle during trade execution on this particular stock. So let's go to Arvind Smartspaces. And I will also discuss why that stock came on my watch list or radar in the first place. So I have this habit of taking a screenshot of the MarketSmith data so that I can go back and check what was I looking for in the stock tried to, before I attempted to buy the stock. Okay. So this is Arvind Smartspaces. Have a look at this base. See, it broke out nicely. You have two follow through candles as well. So if you had bought in this band, you would be making a good profit. Okay. Provided you held on to those shares. I made an attempt, but I could not handle the trade because it was too volatile during execution. Okay. I want to explain that trade execution story in this. However, before that, let us follow our regular drill. What do we do with a stock? We do comparative analysis, we do technical analysis, we do fundamental analysis. We want to know whether our stock is strong in each of these areas. Okay. So, first, let us do comparative analysis. In comparative analysis, see, this is 30th of October. So, wait, just before this, okay, on 30th of October, just before this, what was I looking for on MarketSmith? This was the day I attempted to buy the stock. Now have a look at this. This is the screenshot that I took just before the breakout day. Look at the fundamentals, 369% growth in EPS, 265% growth in sales. The number of funds has increased. Up down volume ratio is 1.6. Okay. Return on equity is not that great. Management ownership is more than 50%. Okay. Fundamentally, the stock looks strong to me. So it is fundamentally strong. Technically, it is strong because you see blue, green, red, the 50 days above the 150 day and the 150 days above the 200-day simple moving average. And the price is trading above the 50-day simple moving average. So that's a nice stage 2 uptrending stock. Then you have minimum 10 candles in the base. Then you have minimum 4 points in the base. So let me draw those points for you. So this is point 1. I think this is point 2. This is the lowest point. Then point 3 and point 4. Okay. So 4 points in the base. So I take point 3 as the buy point. And another icing on the cake is the mother baby candle. So if you see these two candles, the high and low of this candle is within the high and low of the previous candle. That is, in Western technical analysis, it is called as an inside bar. But I call it the mother baby candle combination. Okay. So technically, the stock looks strong because it is in an uptrend. It is forming a base. It has minimum 10 candles in the base. It has minimum 4 points in the base. The yellow line is in the green zone. All our regular drill, the mother baby candle, everything that we look for is in this stock. Except one thing, notice that the volume is below 200,000 shares, which means it is a low volume stock, which means what? We have to micromanage the trade. So any piece of data has an implication when it comes to executing our trade. Okay. So since it's a low volume stock, I decided before even the stock broke out, I had decided that I am going to micromanage the trade because the stock could be manipulated. Another negative factor in this trade is that it's not a tight consolidation on the right side. On the right side, if you see 2, 3 small real bodies, okay, and very tight price action, tight closings, then the probability of breakout is very high. Plus, the probability that the breakout will sustain is also very high. In this case, the stock shot up See, here the stock was in the red zone, and just in a couple of candles, you have a buy point in the green zone. That is not a great price action. You want smooth price action throughout in the base, and you want tight price action on the right side, like 3 to 4 candles on the right side of the base, preferably in the green zone, very tight closing. Okay, very narrow band from where you can pick the stock up as it breaks out. Okay, so not a tight base on the right side, and uh, not great technically. I would say technically it looks good, but not great. That is my analysis of the situation. So fundamentally, the stock is strong. Technically, the stock is strong, but not very great. Volume is low, so which means we need to micromanage the trade. Let us look at the comparatives. So comparatives, we look at these three things. So price strength is 84, which is very good. Anything above 80 is fine. Accumulation distribution rating, this is institutional demand. So this is B. So anything which is A or B is acceptable to me. Okay. Group rank is 109. This is not acceptable to me. And I also noticed that the group rank was declining. The real estate development operations, if you notice, let's see currently what's the situation. So you go to real estate development ops. Okay, 114. So uh, 6 months ago, the rank was 33, which was a premium rank, and now it is 114. So the rank has declined. So the industry performance has declined. And as we know, 50% of the movement in a stock is attributable to its industry based on historical data, okay, of more than 75 or 100 years. So the stock, we can say, comparatively is not strong. Institutional demand is there, price relative strength is there. However, industry rank is not there. The rank is poor, plus the progression. It's the rank has not improved, it has worsened. Okay. So here is a stock which is comparatively weak, technically strong, fundamentally strong. Now that's an opportunity, because a stock which is technically strong and fundamentally strong, if it breaks out and it starts moving up on high volume, then there is a possibility that the comparatives will improve. And when the comparatives improve, now you have a stock which is comparatively, technically, and fundamentally strong. Okay. So now you are dealing with a positional trade. So which means you have to track the blue line. But there are, like, comparatives are weak. It's a low volume stock. There is no tight consolidation on the right side of the base. Given all these factors, I took a decision that I will take the trade, but I will micromanage the trade. And the position size that I decided was 6.25%. That was my approach. Now let's come to the breakout. We have drawn the yellow line. We have drawn the second yellow line, which is 1% above the first yellow line. Our goal is to buy the stock inside this yellow band without taking too much risk. We have to micromanage the trade, which means if the stock starts to go up on high volume, we buy. If the stock starts to come down, doesn't follow through on the 15-minute chart, we sell. So if we are buying and selling within that band, our loss will always be contained within 1%. Okay. So that's the approach that I took. And you will notice how the stock played with me. Okay. Let's go to 30th of October 15-minute chart. So this is 30th of October. So this is the first candle of the day. You notice very high volume compared to the blue line, high volume compared to average volume for the 15-minute period. Okay. 15-minute time frame. On the 15-minute time frame, the blue line is the 50 period SMA. On the daily time frame, the blue line is the 50-day SMA. Okay. It's allowed, no problem. So in the first 15 minutes of the day, the stock starts to move up on very high volume, and I pick up the stock. Okay. In this, I start buying shares. Now I will give you an example of 100 shares. I did not buy Like 100 shares is not what I bought. I'm just giving you an example. I'm just saying that assuming your plan is to buy 100 shares or maybe 1000 shares, okay? When the stock ticks trades one tick above the yellow line, okay, in that case, you you start buying the stock, but you don't jump in with all of your 100 shares. So for example, when it trades one tick above the yellow line, you buy 20 shares. Then you give it 1 or 2 minutes, check whether volume is coming in, check whether price is started to move up within that band. Okay, wait 1 or 2 minutes. If you see price and volume confirmation, buy another 20-25 shares. Okay, wait another 1 or 2 minutes, check for price and volume confirmation, buy another 30-40 shares. Okay, again wait for 1 or 2 minutes, wait for price and volume confirmation, buy another 20 shares. So you're gradually making your purchases as you're getting confirmation. But imagine you buy 20 shares as the price trades one tick above the yellow line. You buy 20 shares, and instead of moving up, the price begins to come down. Will you buy the next lot of 20 shares? Will you buy the next lot of 40-45 shares? No. So basically, what I'm trying to say is you buy the stock gradually in small amount of quantities as it keeps giving you price and volume confirmation within that candle itself. Okay, that's a 15-minute candle, and here I got that confirmation. So I filled up all my positions. So let's say my plan was to buy 100 shares, so I ended up buying 100 shares during this move, and I waited for the close. The close was above the yellow band, not just above the first yellow line, but above the yellow band, which was a very positive sign. The stock shot up 4.52% in just 15 minutes. That's a very good sign. Okay. So I got an entry into the trade. Now comes management. Okay. Micromanaging the trade. So if you see this, the stock started to move down. Okay. So I gradually, as it started to come back into the band, see, ideally, a true breakout stock is something that never comes back into the band. Once it breaks out, it starts moving up on high volume. It sustains there, maybe 1 or 2 hours. The momentum continues. After a couple of hours in the market, the stock takes a breather. It goes sideways for some time. And before the close of the market, okay, just 1 hour before the close or half an hour before the close, it inches up another 1 or 2% with high volume, just to give you that confirmation that it is going to close above that yellow band or above that yellow line. So that is how an ideal breakout stock moves. But imagine a stock which breaks out of the yellow band in the first 15 minutes, and immediately in the next 15 minutes it starts to come back inside the yellow band. It means that the stock is not doing what you expect it to do. In that case, what do? You start cutting down your position size. Forget about the stop loss. You have to manage your risk with your position size. What will you do by moving the stop loss? If you start moving the stop loss, they will eventually hit your stop loss. Okay. Best way to manage risk is to keep reducing your position size. So in this case, as the stock began to move down, came back into the band, I started selling 20 shares. Then it started to move down more, another 20 shares. Then it started to move down more, another 20 shares. So I'm gradually buying, I'm gradually selling. So my average buying price is somewhere in this yellow band, and my average selling price is somewhere in this yellow band, and this entire band, okay, it's 1%. So my net loss on this position is 0.5 to 1% roughly. Okay. So that's my first attempt to buy the stock. Okay. And I lost roughly 0.5 to 1% because everything is happening inside the band. I don't want to trade the stock outside the band. If I buy above the band, I'm buying an extended stock. If I buy below the band, I'm buying a premature stock. So both are mistakes. Okay. So don't do that. So first attempt failed, lost 0.5 to 1%. Now, you see the stock bounces from the yellow line. Okay, it starts to go up. This is a bullish candle on high volume. See, if you look at this candle, you have a long lower shadow. Okay, the longer the lower shadow, more bullish is the stock. plus the closing of this candle is positive compared to the previous candle closing. So this is actually a bullish candle, even though the color is red on high volume. Okay. So as it started to move up back again, as it started to bounce from here, I started buying back the shares. Okay. So this is my second attempt. So now it starts to move up. It starts to come down again. Okay. By the time it moved up here, I had already bought my shares. So I'm buying again inside that band as the stock is moving up, as the stock is pulling back. Okay. Now look at the next candle. It started to come down, but as long as it is above the yellow band, I don't have any problem. The moment it started to come down, I decided that okay, let me give it some time. Let me give it some breather. This is the second attempt. The stock looks technically strong. The stock looks fundamentally strong. Why not give it some room? So I decided that I will keep my stop loss at 889.90. So I placed my stop loss here at 889.90 because I knew that even if the stock comes down and hits this price, my net loss on that trade is going to be less than 1% because I have on the second attempt too, I have bought back all my shares within that 1% band. Okay. So I kept my stop loss at 889.90. And as you can see, the stock never came to that level. Okay. So this candle was successful. I was able to hang in there with this trade. But look at this shakeout. Okay. The next candle, it closed very powerfully. Like this was a nice breakout. It comfortably closed above the yellow band. But before that, it shook me out. In the second attempt itself, I was gone. And before I could think of taking the third attempt, see, I don't take more than 3 attempts on a stock. Before even I could think of taking the third attempt, the stock moved very rapidly from this low to the opening price and up. The movement was so fast that I could not handle the trade. I could not get in my shares. Okay. So 2 attempts and I was out of the stock. My stop loss was hit. Okay. I was completely out. So again, I lost 0.5 to 1%. So if you see, roughly, I must have lost around 1.5 to 2% combined on this stock on the position size, not 1.5 to 2% on portfolio. I'm talking 1.5 to 2% loss on this position. Okay, so this is how I micromanaged the trade and I lost the stock. I never went into the trade again because the stock began to trade above the yellow band. That's an extended stock for me. I will not buy more than 1% above the yellow line. So roughly 1.5 to 2% loss here. Then there was a trade which I took, which was Polymedicure. There I booked another, let's say 1% loss. There again, I took, I think, couple of attempts. I don't remember. Take 1% loss there. So 2 plus 1, that's 3%. Then there was another company, Radico Khaitan, where I think I took couple of attempts. Again, I lost 2% there. So 2% on Radico Khaitan loss, 2% on Arvind Supermart loss, 1% or 1.5% on Polymedicure loss. So roughly, I have lost 1.5%. Then on Dixon Technology, I lost another 1.5 to 2. I think it was 2%. Okay. So I lost another 2% there. So around 7 to 7.5% is my loss given these 3, 4 trades. However, if you look at profits, I have booked more than 15% profit on Dixon. That's number one, which is already twice the amount of loss that I have booked. Plus on Polymedicure, the stock from my buy point was up 26% uh, in the latest trading session, and I sold 20% of my shares 13% above the buy point. So the Dixon trade already covers my loss by more than 2 times. Plus, I have booked partial profit in Polymedicure. Plus, I have 18% position, 80% position size still left in Polymedicure. Okay, which is already up like uh, 15% maybe from my buy point, which is unrealized gain. So that is again another 2 times more than my loss. So if you notice what I'm doing, I cannot control which stock will give me profit or loss. But what I do control is the risk, which is why you notice that combined all these 3, 4 trades, my profit is easily 2, 3 times more than the loss that I have booked. So this is what trading is all about. You don't have control over the stock price, but you have control over your trade execution. You have control over your risk. So if you carefully note down the names of the stocks that I have mentioned just now, and you go back and watch all of those videos, and you sit and calculate the profit and the loss that I have booked, you will realize that we are really talking about a reward to risk ratio of about 3 to 1 here in my trading, at least in this month or previous month. Okay. 3.5 is a fantastic reward to risk ratio. I can use my, I can still use my profits in Dixon Technologies to finance 2, 3 more trades. And out of those 2, 3 more trades, I am likely to get 1 or 2 profitable trades, assuming I go into a stock which is technically and fundamentally strong. So you keep compounding your gains by going into higher quality stocks and using your realized gains or realized profits to finance your future losses. And I prefer to book losses within that yellow band. I am very comfortable with trade execution risk. I am not comfortable with stop loss risk. Stop loss risk is much higher than trade execution risk. While trade execution, how much can you lose? Like 1%, 2%, 3%. But with stop loss, you could lose 4%, 6%, 8% maybe sometimes. So that is why, as I keep saying, there are 2 ways to manage risk. One is handling the position size, reducing the position size as it goes against you. Second is playing around with the stop loss. I am not a big fan of playing around with the stop loss. For me, it's easy to adjust the position size. Okay, you can easily buy and sell shares. In split seconds, you can quickly come down from 15% position size to 5% position size. In Dixon, I remember I was taking 5% position size. In Polymedicure, by mistake, I mentioned in the video that I took 5% position size, but it's not actually 5%. My position size is 6.25%. Here again, my position size was 6.25%. I have slightly increased my exposure to the market as the market has started to improve in the past couple of days. At least I see that the stocks setups have improved. Earlier, I used to get like 400 stocks. Last week, I used to get 400 stocks in my screen. Now I'm getting more than 500. So although the index might not be doing well, but there are pockets of opportunities in the market which I am finding. So that is why I am slightly increasing my risk exposure. So you see, my approach is extremely flexible depending on market conditions, depending on the movement of the stock while I am executing the trade. I am managing my position. So this trading comes down to managing your risk. Okay, that's what trading is all about. Okay, it's the same as a commercial pilot uh, flying a commercial aircraft. Okay, he's not a pilot. He's basically a risk manager. Okay, he or she is trained to maneuver the commercial aircraft in a proper manner so that there is no inconvenience for the passengers. So he's just following protocol. Okay, he's just following a checklist. So he or she is just a risk manager. He or she is not a commercial pilot. Okay, our role is to manage risk. Everything else is taken care of by the system itself. Okay, so this is a stock what I wanted to discuss with you. Have a look at this stock. It has started to go up. It's painful to watch this kind of price movement in a stock which was on your watch list where you did all your research and things like that. But anyways, I wanted to discuss with you this. I discuss with you my profitable trades and loss making trades just to give you an idea of how difficult this skill is. Trading is not an easy skill. Trading is a highly specialized skill. Okay, not everybody can do this. There is psychology involved, there is system involved, there is discipline involved. Okay, so I hope this video has added value to your trading journey. Please share this video with your friends, family, and business associates. Those of you who want to become professional stock traders, I thank you again for your support on this channel. Most importantly, I thank you for your time. Okay. Take care. I will see you tomorrow with another fantastic video.